All right, hello everybody. Welcome to another episode on my channel. Today we will be doing more of a beginner investment video and specifically looking at index funds, ETFs, and mutual funds, kind of defining what they are, their similarities and differences. And then we will be looking at the different types of ETFs that you can actually invest into. We'll be doing that both on the US and Canadian side. And then we'll be doing a comparison to see which ETF would fit your specific investing goals best. So we'll be looking at a tool that Vanguard has that allows you to compare their different ETFs that they offer across the different sectors and see which one might actually fit in line best with your own individual investing goals. And then finally, we'll be looking at how to actually invest into them. So without further ado, my channel is kind of just straight to the content, straight to the point. Let's dive right in and let's look at what an index fund, ETF, and a mutual fund are. So have you follow along? I'm just going on Google, typing in Vanguard. I'll be doing the US side first. So you go to Vanguard here. I'm just using Vanguard as an example. You can use Schwab or TD or whoever, but I like Vanguard. Vanguard site, their products and their explanations are pretty easy to use and easy to follow for learning purposes as well. Click personal investors. All right, so I click personal investors and we're going to do investor resources and education, choosing our investments. So because we're going to be looking specifically at ETFs and index funds and mutual funds, I'm going to click a comparison, click learn more. Okay, so this is comparing ETFs and mutual funds specifically, but for your reference, an index fund. So what an index fund is, when you hear people say, oh, the S&P 500 index or the Dow Jones index, the index is really a collection of stocks that trade, which these other products such as ETFs and mutual funds, they try to track that index. So basically copy or replicate the performance of that index. So usually what people do is they'll buy an ETF or a mutual fund that tries to replicate that index in that ETF or mutual fund, if that makes sense. So for instance, if I'm interested in investing in the S&P 500, that's a popular one. A lot of people will pick an ETF that tracks the S&P 500 index and so on. So ETFs and mutual funds, a comparison. Again, I'm just here on the Vanguard site. It's very easy to follow. So first they list the similarities and then the differences. We'll be looking at the similarities first. So similarities between ETFs and mutual funds. The biggest similarity between ETFs or exchange traded funds and mutual funds is that they both represent professionally managed collections or baskets of individual stocks or bonds. So what's great about both of these is you're not just investing into one company, so there's a lot less risk. You're getting a wide variety of exposure to different companies or different equities and investments by just purchasing this one ETF or mutual fund. So you get very great diversification by buying one of these products or investing in one of these products. So there's other traits that ETFs and mutual funds have in common. Both are less risky than investing in individual stocks and bonds, is kind of what I just touched on. So ETFs and mutual funds both come with built-in diversification. One fund can include tens, hundreds, or even thousands of individual stocks or bonds in one single fund. So if one stock or bond is doing poorly, there's a chance that the other is doing well. So this could help reduce your risk and overall losses. So that's kind of what I spoke on before. If you have a basket of stocks and one company in there does, poorly, you have some other ones doing better, it kind of evens that out or de-risks the whole portfolio or your ETF or mutual fund. Now, both offer a wide variety of investment options. So ETFs and mutual funds give you access to a wide variety of US and international stocks and bonds. You can invest broadly, for example, in a total market fund or narrowly picking a specific sector or specific criteria such as investing for high dividends. It all depends on your personal goals and investing style. So just remember, like I said before, we're going to be looking at which of these ETFs might be best for you depending on your own personal goals and investing style. Everybody is different. Everybody has a different investing style or different goals or different investing needs. So it always depends on your personal goals and investing style. And that is the best way to pick an ETF or a mutual fund that is right for you. So they offer 75 ETFs here on the US side and 160 mutual funds here on the US side as well. Both are overseen by professional portfolio managers. So a lot of people think that mutual funds are the only ones with PMs or portfolio managers, but the ETFs also have them as well. So ETFs and mutual funds are managed by experts. Those experts choose and monitor the stocks or bonds that the fund invests in, saving you time and effort. Although most ETFs and many mutual funds are index funds, the portfolio managers are still there to make sure the funds don't stray away from those target indexes or indices. Like we said, they're trying to copy these indexes, and the PMs or portfolio managers are there to make sure that they are, pretty much in line with those indexes. Vanguard, both are commission free here if you were able to open a Vanguard brokerage account, and a lot of the other brokerages where you buy these investment products, such as Wealthsimple, you can buy ETFs on the Canadian side for free, and then probably some other ones in the States as well. So those are the similarities. Now let's look at the differences between ETFs and mutual funds. So if you prefer low investment minimums, an ETF could be suitable for you. You can buy ETFs for as little as $1. So this is great. If you are starting off with a little amount of capital or a little amount of money and you want to start getting invested, an ETF could be very great for you. You can start off investing probably not $1, but if you were investing $1, you could. You could buy fractional shares. You could buy 10, 20, 30 dollar increments, $100 increments, 50, $200, $300, $500. So it all depends, and it's very accessible. So if you had a little amount of capital, you could definitely start investing into an ETF, and that might be great for you. So mutual funds, it may not be a suitable investment because the initial investment, minimums can be high. So here at Vanguard, most of theirs have a $3,000 minimum. So you would have to invest initially $3,000. A lot of people, when they're starting their investing journey, they don't have $3,000 to get started. So they might choose an ETF. So if you want a more hands-on control over the price of your trade, so this is talking about your types of orders. So if you have a market order or a limit order, so I'll let you look at that. It's most people, they end up doing market orders if they're investing into ETFs or mutual funds, because the spread or the trade price is very similar usually. So you can just stick with a market order or a limit order, but I'll let you read that on your own time. So if you want to repeat specific transactions automatically, an ETF may not be a suitable investment for you because you cannot make automatic investments or withdrawals in and out of ETFs. So these have to be kind of traded like a stock, or where you would want to set up things automatically. It's probably not the best way because you can buy and sell these on the open market, but a mutual fund could be. You can set up automatic investments and withdrawals out of your mutual funds based on your preferences. So if you're looking for an index fund, ETF and a mutual fund could both be suitable. So here, most ETFs are index funds because they're referred to as passive investments. So if you take anything away from this whole video, please remember that ETFs are passive, and mutual funds are actively managed. So ETFs passive, mutual funds actively managed. So what they mean by passive investments is these ETFs are basically trying to replicate the performance of the underlying index, and that is done passively. So it's done through automatic computers, algorithms. They just kind of track to make sure that the percentages of the stocks in that basket stay as close as they can to the index funds. So you don't really need a lot of people to do that. It's mostly done by computers or passive investing. Now, a mutual fund, they are done more actively or active managed, because you have these PMs or portfolio managers that make up a basket of stocks. So they actually pick the stocks in here. ETFs usually have, hundreds or thousands of stocks. Mutual funds kind of, they have a lot less. It's not to say that they can't have hundreds or thousands, but a lot of them usually have, anywhere from 20 to 50 companies in there. And those companies are handpicked by an individual portfolio manager. Therefore, it's actively managed. The portfolio manager decides what companies or equities go into that mutual fund, and they decide which ones to sell. And they're doing that all the time, trying to beat the market or beat the indice. And that's a form of active management. So that's ETFs and mutual funds, at a super high level. Now let's go and look at their ETFs, because a lot of people, they prefer investing in ETFs. They have low cost benefits, and they're very, very accessible. Like we saw, you can invest with little money. So the focus of this video now is going to be investing in ETFs. But if you did want to look at their mutual funds, you could just click here and look at their mutual funds as well. So, and you can look at both. So we're going to be looking at ETFs, but I encourage you to go look at mutual funds if that's something you were interested in, and you can compare mutual funds to ETFs on your own time. So we're going to be looking at ETFs. Now, there is a lot of ETFs. So as you can see, there's 380 results here. So what we're going to do is we're going to be looking at some specific ones that are actually, very, I wouldn't say famous, but that are most commonly looked at when investing and people want to get exposure to. So you can scroll down and look at them, individually if you wanted. I would recommend it if you're, have a full day to go through these and see which ones might fit your best investing style. But we're gonna search for some particular ones here that I would like to share with you. So a very common one being VOO. So here we go, Vanguard, S&P 500, ETF VOO. I was looking at VFE, but that's for the Canadian side. So here on the US side, it's called VOO or VOO. So VOO, the Vanguard S&P 500 ETF. I'm sure you've heard people say S&P 500 a lot. So this ETF tracks the S&P 500, which are the 500 largest companies by market capitalization in the United States. So management style, it is an index. It follows that passive investing approach that we looked at. The asset class, it's in general, domestic stock. Category, it's in large blend stocks. Risk and reward scale, I really like that Vanguard does this. So it goes from 1 to 5. So 1 being the least risky, 5 being the most risky. Here it's telling you that this ETF is kind of in the 4 range. So it's not the riskiest, but it's not the least riskiest. But you do want some risk if you have some a longer investing time horizon, because oftentimes, a little bit more risk can add to more reward. That's not always the case, but it usually is. So that's just something there to keep in mind for your investing goals and your investing, risk tolerance. Expense ratio. So the expense ratio, so this is essentially the expenses that the fund pays. It needs to have administration there, accounting fees, audit fees, some other types of fees just to kind of keep the fund running. So what this means is it's 0.03%. So for instance, if you were investing $100, this would be 3 cents that you would pay as in fees for investing into this ETF. So it's super, super cheap. The ETFs, that's why a lot of people choose ETFs, because they are a very, low price, or they have low costs associated with them when investing. And if you can find a broker that gives you no commissions on having to buy these ETFs, you're essentially not paying a cost on buying it. You're just paying the cost for having it in your investment portfolio, which if you're paying 3 cents for every $100, that is super, super cheap. Here we have the dividend yield, or the trailing yield, 1.57%. So not super high here. The market price and the net asset value price, those are usually very, very close. So let's scroll down. So here we can see the performance year to date. So year to date, it is up about 14.17%. So that is great. That's been the huge rally with the large cap tech companies making up a large part of this ETF, which we will look at in a minute. So it's up 14.17% year to date. So this is the ticker symbol VOO. You can find it right here as well. So if you're looking to buy this later, when you're looking at a brokerage, you would just type in VOO, and then you could buy it on the US side. So if you scroll down, we can see the product summary. Invest in stocks in the S&P 500 index, like we said, representing 500 of the largest US companies. The goal is to track or closely track the index's return, which is considered a gauge of the overall US stock returns. Offers high potential for investment growth. Share value rises and falls more sharply than that of funds holding bonds. So again, that is reflected here in this risk reward scale. So it does fall more sharply, but you have a higher potential for future returns. So it's more appropriate for long-term goals where your money's growth is essential. So long-term, you're holding this one for the long term. Again, they have this risk reward scale, and if you want, you can click why should I care about risk. So that's something I would encourage you to look on as well. Price, minimum investment $1. So if you're getting this for Vanguard, you can get in as $1 by fractional share. So very, very accessible to investors with small capital or just starting out. Here you can look at the average annual performance. So they have it here year to date, 1 year, 3 year, 5 year, 10 year. So since inception in 2010, it has returned about 13.29%. So that is this VOO right here, 13.29% per year, over the past 13 or 12 and a half years. So that's pretty good. And the benchmark here, the actual S&P 500 index, is about 13.33%. So there's a little slippage here. So that's when they are trying to, match this index. There's a little slippage. It can't be 100% right, but it's still pretty darn close. One thing to note here is, you might be saying 13.29%. That's a great return per year, and it is. But please remember, this has been only over the past 12 years. When you're looking at other ETFs, and if you can actually span this one out, over 20 years or 30 years, you'll see this come down a lot. Actually, this will actually be closer to, 8 or 8.5% when you're comparing it to other ETFs, which we will look at as well later. So scroll down. So here's the expense ratio. Like we said, that's the expenses. And then this is just what they say, the volatility. So they're measuring the volatility. Usually if it's 1, that means it's basically in line with being as volatile as the normal stock market. Scroll down some more. There's all this other information that you can look at in your own time. Now what we're going to do is look at the actual composition of the portfolio, or what is in this ETF. So the stocks in here, about 505 stocks. In the S&P 500, the benchmark is about 503. So again, it's very close to 500. The median market cap, so this is the market capitalization or the dollar value in here. The earnings growth rate, very high at 18.3%. So the companies in here within this ETF, they grow their earnings at about 18.3% per year. Price to earnings ratio, so that is a function of the earnings generated by the companies per share divided by the actual price of those companies within this index. So 22, so that's on the very high side or on the higher side. But if you're growing earnings at a very high rate, sometimes that ratio or that price to earnings ratio is justified. Price to book ratio, it's another ratio you can look at. Return on equity, so 24.6%, so very high return on equity. And then the total assets of the fund being 823 billion over here. The investment style, so this is awesome infographic that they've included here. So the investment style and the market capitalization. So the market capitalization is a measure of how small, or how large the company is considered in terms of market cap or the investable dollars into the company. So here we can see that the investment style is a value, blend, or growth. So here, this VOO ETF or the S&P 500 ETF is a mix of large cap blended. So it's a portion of the large cap capitalization companies are actually made up of both value companies. So that's companies that are more established that aren't growing as fast, and growth companies which aren't as established but are growing rapidly. So it's a value of investing into both of these, or sorry, not a value, it's a blend of investing into both value and growth here. So risks associated here, because this is considered a moderate to aggressive fund. Feel free to read this. It's kind of just saying that, you should have a long-term investing time horizon, 10 years or longer. If you're seeking a growth capital here as your primary objective, so that's your total return. And then you have to be prepared to endure sharp and sometimes prolonged declines in share prices that occur from the stock market in time to time. So in other words, it's saying prices can be volatile, but if you're comfortable with that and you'll hold it for the long term, then you should do just fine. But again, it's kind of a disclaimer. You should be aware of these risks when investing in these ETFs. But if you have a long-term time horizon and you're just dollar cost averaging, so adding in money every week, 2 weeks, every month, every year, you should be kind of okay in the long run. So this is the exposure. So this is awesome. I love this. And for full disclosure, I like the US Vanguard site a lot more than the Canadian one. It just looks a lot nicer and a lot cleaner, but we'll look at the Canadian one a little bit later in the video and you'll probably see what I mean. But here you can see the different sectors that this ETF invests into. So communication services at 8%, consumer discretionary at 10%, consumer staples at almost 7%, energy at 4%, financials at 12%, healthcare 13%, industrials 8%. Information technology being the highest, so without looking at this, we kind of already know what's probably going to be in here. It's going to be the large cap tech like Apple, Microsoft, Google, etc., Amazon. So you have materials in here at 2%, real estate at 2%, and utilities at 2%. So the actual holdings detail, we're going to see, I believe, the top 10 holdings. Yeah, so top 10 holdings here. You can see the holdings right here. And the holdings are the first holding being Apple. Apple makes about 7.5% of this total ETF. So when you buy this ETF, say if this was going to be your only investment and you're investing into this ETF, which is not a problem at all, you're still getting very good diversification. Just remember, by buying this ETF, 7.5% of your total investment is going to be in Apple. So you're already going to have a significant position in Apple. And I'm mentioning this because I see a lot of people, they'll buy ETFs, but then they'll also double dip, or they'll kind of forget that they're already exposed to specific companies. So they might go and buy VOO, and then all of a sudden they buy another 10% of Apple in their portfolio. Now they need to realize that, well, they have a total of 17.50% of exposure in their portfolio just to Apple. So something to be cognizant about, always keep aware of that. Your, cross allocation, or where you're getting exposure to multiple times. So a lot of times if you're buying these ETFs, you might not need to add additional exposure to these individual companies, but you totally can if you're comfortable with that risk of kind of having a higher investment percentage into a specific company. For me, I don't really invest into ETFs besides through my work match, which is kind of a mutual fund, but that's because I get a 1-to-1 match or 100% match every year. Otherwise, I invest in individual companies because I have the time to research them. But these ETFs, if I didn't have the time to research them, I would definitely be buying ETFs because it's just a very easy way, low cost way of investing into the stock market. So that was my rant there. Apple here at 7.50% of this. Microsoft not far behind at almost 7%. Amazon at 3%. So you can see the tech heavy names here. Nvidia at 2.6%. Google here, so Google are under Alphabet, it's kind of at a combined percentage of almost 4%, 3.9% with these two. And these are just the different share classes. One is voting, one is non-voting. Honestly, you could buy both and do just fine. Facebook you have in here at almost 2%. Berkshire Hathaway, Warren Buffett's company. Been trying to get a position in here for a while, but it just hasn't reached my value yet. So it's at 1.6%. Tesla's in here as well, 1.5%. And UNH, United Healthcare, at 1.3%. So that's the top 10 holdings. And if you wanted to, you could just click here, and then you can actually see all of the holdings page by page here and see what the rest of the fund is made up of. So you got ExxonMobil, Johnson Johnson, JP Morgan in here. I hold that as well. Visa, I hold that as well. Eli Lilly, you have Broadcom in here, Procter Gamble, MasterCard, Home Depot, Merck. So I encourage you to, if you like to learn about these ETFs, go page by page and you can see all of the different holdings, and it's super great. And there's a lot of pages. And if you did not want to do that, you could just look at the top 10 or the top 20, as that makes up a large large concentration of this fund as well. So here you can see the distributions that it gives. Again, this kind of, you can read this as kind of on the taxes. So holding ETFs is usually a very tax efficient way of investing, because you're kind of investing, not really selling them. You're holding them for the long term. And then especially if you're in your tax advantage account, you can actually, like myself, I invest in tax advantage accounts. Most of my investments are going to be tax free, or I will pay very minimal taxes. So here are the dividends again, if you wanted to look at those, and the payout dates. It's paying out every quarter, it looks like. So it's paying out every quarter here. So you can see the dividends there if you wanted to look at that. So that is the first one, VOO, the S&P 500 ETF on the US side. So now we're going to look at a couple other ones, and we'll look at them a little bit more quickly because we've kind of ran through that one in detail. So we're going to look at VIG. That is actually a very popular one as well. And because I'm a dividend investor, I would like to look at VIG. So that is the Vanguard Dividend Appreciation ETF. So the Vanguard Dividend Appreciation ETF, And I'm going to run through this a little bit quicker. Trades under the ticker symbol VIG. It has a risk reward scale. It's on the higher end at 4. It's a category of large blend equities. It's invest in stocks. The expense ratio is double that of VFV at 0.06%, but still super, super low here. The yield here is a little bit higher at 1.91%. Scroll down. Year to date, it has not performed as well. It's up about 5.21%, but there are probably a lot less tech-heavy companies in here because it is a dividend appreciation ETF. So it's focusing more on the dividend side of things, and dividend stocks have not done as well. There's been a latest AI craze going on, so they haven't performed as well, but we'll see the performance over time and we can compare that. So the product summary, it seeks to track the performance of the S&P 500 US Dividend Growers Index. So this is the index that it follows. It's passively managed, full replication, stays fully invested, invest in large cap equity, emphasizing stocks with a record of growing their dividends year over year. So that's a big difference here. It's emphasizing stocks with a record of growing their dividends year over year. Again, low expenses right here. So we can scroll down, can again invest in this with very little capital. Performance, so since 2006, now this is a way better representation. It has a lot more time here. We can see that it has almost returned about 9% per year. So this is more in line with average annual stock returns, so anywhere from 8 to 9%. Usually I hear a lot of people online, they'll be saying, oh, just invest in the S&P 500 and you'll get a 10% return over the past, however long. But really they're not taking into full consideration decades, like 20, 30 to 40 years. They're kind of just looking at the past 10 years or past 15 years. And sure, that can give you 10%, but there's so many different factors that can be different over the decades. So we've had low interest rates over the past decade. That has made it a lot easier, or there's been a lot more what people call free money. So it's been easier to obtain a 10% return. When you're looking at this kind of takes into account, the 2008, 2009 crisis, the financial crisis. There's other crises, in 2000 with the dot-com bubble. So this is a lot more realistic annual return in my opinion. And the average stock market has done about 8 to 9% per year. It's not kind of at that 10% range. So this is a lot more realistic in my opinion. So again, you can look at that average annual return. Scroll down a bit. We can go and look at the composition. So here the portfolio composition, smaller number of stocks compared to the S&P 500 or VOO. So this VIG has about 314 stocks. It has a earnings growth rate, still very high at 18.2%. Price to earnings ratio is a little bit lower at 20.5. Price to book here, the return on equity is 26.8%, so still very high. And then here we can see the investment style is very similar to that of VOO. It is a blend and a large cap. Again, risks associated here. They just highlight this, which is great because it kind of keeps reminding you that, things are risky, but as long as you have a long-term time horizon, you keep investing, you should probably be fine. But again, that is good to read. So we can look at the weighted exposures. Communication services at 1.3%, consumer discretionary at 7%, staples at 12%, energy at 3%, financials at 17%, so it's a little bit higher. Healthcare higher at 16%, industrials 12%, information technology, the VOO was around 28 or 29, I think. This is a little bit lower at 22. And it'll probably include Apple and Microsoft. We have materials here at 4% and utilities at 3%. So top 10 holdings here, you see Microsoft and Apple have switched spots. So Microsoft is at 5%. This is because Microsoft pays a higher dividend and it is appreciating or growing at a higher rate than Apple is. Apple is at 4.5% here of this total fund. Now UNH, United Health Group, is actually down here at 10 before, so now it's jumped up to 3 compared to the VOO. So VIG has it at 3. The third place here in the top 10 holdings, and it's at 3%. ExxonMobil, more mature gas or oil company, so that's paying about 3%. Johnson & Johnson, healthcare company, more mature at 3%. JP Morgan at 3%. Visa at 2.5%. P&G at about 2.5%, Broadcom here at 2.3%, MasterCard here at 2.26%. So the top 10 holdings, there is some cross here between VIG and VOO, but notice that some of the holdings here have changed. Visa's a higher concentration here, MasterCard's higher here, Broadcom is here, P&G, JP Morgan. This is because the rate that these companies are growing their dividend is very high or a lot higher, and that is the criteria for it being included in this VIG ETF. So this could be great for dividend investors. I actually like these top 10 holdings a lot. I don't like some of these other companies don't fit with my investment style currently, such as Exxon and Johnson & Johnson, but a lot of these other companies are great, and I actually have them in my portfolio as well. So again, if you wanted to look at all of those, you could scroll and look at each of the pages here and see the holdings here individually. So that was VIG. Now what we're gonna do is look up one more. So that was dividend growth appreciation, but what if we wanted higher yields now? So this might be if you're, later in your investing time horizon, you're kind of a little bit closer to retirement, or you just want higher dividend yielding companies because you like getting that higher dividend yield or that higher dividend income now because it keeps you motivated to keep investing, and that's totally fine. So this is going to be focused on VYM, the Vanguard High Dividend Yield ETF. So again, it's number 4 here on the risk scale. Expense ratio is the same as VIG, very low. Large value companies, so this is different. Large value companies and invest in stocks. You scroll down and you can see the yield here is a lot higher. It's basically double the other two ETFs that we looked at. It's 3.32%. So you're getting a 3.32% dividend yield. So it's a lot more dividend income coming into this fund. Scroll down, we can see that the year-to-date returns are negative almost 3%. So has not done as well year to date, but that's only this year to date. We have to look at it over a long time period, and this is a more mature companies included into this ETF. So the product summary, it seeks to track the performance of the FTSE High Dividend Yield Index, which measures the investment return of common stocks of companies characterized by high dividend yields. Provides a convenient way to track the performance of stocks that are forecasted to have above average dividend yields. So this is higher than average dividend yield companies. It's still passively managed. Scroll down again, accessible. You can invest into it with very little funds. So since inception, since 2006, this has returned about 7.6%, almost 8% per year. So this again is focused more on higher dividend income. So a lot of these companies are going to be more mature, and they're paying out a higher portion of their net income as dividends, or their cash flows as dividends. So this return is a lot lower than the higher growth companies included in the original ETF that we looked at, VOO, and even in the Vanguard dividend appreciation ETF, VIG. So again, it's a lower return, but this is more mature companies, and this could be an ETF that some people are fully invested in. They might have this as a complement in their portfolio, being 20% if they want that higher dividend income, or when they're later in their retirement years or getting close to retirement, they might switch to an ETF like this because they require more income in those years. Scroll down, we're going to go look at the composition here. So pretty diversified. It's got 466 stocks in here. Earnings growth rate is a lot lower at 12.5%. So the earnings aren't growing as high as VOO, for instance, at 18% per year. They're growing at 12%. So that kind of makes sense because they're more mature companies, or I'd expect them to be more mature companies included in this ETF. Price earnings ratio a lot lower at 3.8%. So it's a lot more reasonable price that you're paying for this earnings growth. And then you have the return on equity being at 15.8%. So again, lower than the other two ETFs that we looked at, but still very respectable. Here we can see the style. So it invests in large cap value companies. So it's in the value section here. So it's investing in what people call value companies. So that's a lot more mature, established, profitable, cash generating companies, not focused on as much growth. Here again, they have that blurb on risks, so you can read that. Now we're going to be looking at what makes this up. So basic materials at 2%, consumer discretionary at 9%, consumer staples at 13%, energy at 10%, financials at almost 20%. So it's a lot higher, almost double than the other two ETFs that we looked at. Healthcare at 13%, industrials at 11%, technology 7%. So it's a lot lower compared to the other two ETFs we saw. It's at 7% compared to 22% or 25% in the other ones. Telecommunications and utilities. So you see a lot more of an even spread here in my opinion, and a higher emphasis on financials as they pay out more dividends, and energy as well. Even consumer staples. So it's a pretty good spread in terms of sector exposure in my opinion. So that's something to consider as well. That might fit in your investing goals if you want to diversify across different sectors. So the top 10 holdings, ExxonMobil, they pay out a very high dividend amount per year. So it makes about 3%, Johnson & Johnson Healthcare 3%, JP Morgan 3%, Procter & Gamble 3%, Broadcom 2.5%, Chevron here, similar to Exxon is 2%, Home Depot 2%, Merck & Co 2%, Pepsi is included here at 2%, and AbbVie almost 2%. So there's still some cross here between this and VIG, but there's also some other companies included here as well that were not included in VIG because they might be more mature companies not growing their dividend at as high rates as the other companies in VIG, but they still pay out a lot of current income. And there is a lot of still, cross allocation between these portfolios, or the same holdings held between a lot of these ETFs. So they are very similar. It just kind of depends which one you want to pick based on your investing goals and your investing time horizon. And I'll keep stressing that throughout the video. You might get sick of hearing it, but that it is what it is. That's how you can always pick which one of these ETFs would be right for you. So again, you can go through the holdings, each of the holdings pages here. It's very, very detailed and super easy to follow. So that was the US side of looking at ETFs. And now we are actually going to be doing a comparison of these. So let's go click compare. So we've picked VYM here, and then I'm also going to add a fund or an ETF. Vanguard, it's going to be an ETF. And then I'm going to enter the symbol here. So it'll be VG, Vanguard Dividend Appreciation ETF. That has been added now. And it's giving me a warning here, just to be aware that these fall into different investing categories, so the comparison may not be complete or accurate. That is just saying that because they have different investing styles, such as the categories here, the investing styles are different categories, like large value compared to large blend, to just be aware of that. So again, you have to compare the ones that you think are the best for your investing style and your investing time horizon. Now we're going to be looking at Vanguard again, ETFs, and we'll be looking at VOO. Okay, now I've added that one as well, and I can even add some other ones. What I didn't touch on was what we could look at is a very popular one for growth or technology investing. It's called VGT. I encourage you to go look at that one as well, but that is a sector-specific ETF. So what we looked at was based on specific categories, such as compared to market cap, such as large, and then whether it's value or a blend of growth and value. But here the category, you could pick a specific sector, that being your category, such as technology. You could pick, they have some for consumer discretionary, financials, healthcare. Here I've picked technology, so we can look at that one as well. And again, that is on the highest risk scale. So when you're investing in a specific sector, it is more risky. So this is a really great tool that Vanguard has. You can compare them literally line by line here. And you don't have to keep flipping back and forth between the different ETFs to see which ones would fit your investing needs. You could have all the information just presented to you right here at the click of a button, and you could totally just scroll down. So you have the symbols here, the tickers VYM, VIG, VOO, VGT. They all invest in stocks. So the different categories: large value, large blend, technology, the risks, the risk scale that they have here. So these ones that we looked at being at a 4, this technology, because it's investing in technology, is at a higher level 5. The expense ratios, again, super low. Even that technology one, it's a little bit higher, but it's 10 cents on $100 compared to 3 cents or 6 cents. So again, not a very large difference or a significant difference there. You can see the bids and asks. And if you scroll down, you can actually see the performance of these. So year to date for the VIG, you can see that's down 1%, or sorry, VYM. You can see VIG is up about, almost 2%, VOO is up about almost 8%, and the tech ETF, being very concentrated in technology, is up about almost 21% due to the high appreciation of the large blue cap technology stocks such as Microsoft, Apple, Google, NVIDIA, all those ones. So again, you can compare it, and you can compare it over different timelines, which is super great. So we can compare it, since 10 years, if you're looking at a 10-year time horizon, 10%, 11%, 12%. So these are all fairly actually pretty consistent. And then, technology with its a large growth in the past 10 years has kind of almost doubled these. But you can definitely compare the rates of return here as well and use that as a reference over a 10-year period, or you can do it since inception, and you can see the inception dates here. So it's really cool because you can see when this fund was started, how close or how far apart their performances were, and you can compare that to the different funds that you could invest into. There are different ETFs. So again, you can use this tool, and I would highly recommend you using this tool when comparing and deciding to see which ETF would fit your investing goals and your investing time horizon. So that was the US side. I hope you enjoyed that. Now we're going to be looking at some of the Canadian ones. I'm not going to be doing a comparison of the Canadian ones, but we'll just be looking at the Canadian side of the ETFs that we can invest into. So Vanguard Canada, I'm going to click that. So it's still, pretty clean, this website. We can view their products here. I just don't like it as much, but that's okay. It's still, gives you the same information. So we're going to filter by product type, ETFs. We're going to search for passive ETFs, and then we're going to be looking at equity ETFs because we want to invest into equities. If you want to look at the other ones like fixed income or actively managed, you are totally free to do that. So they've got about 43 funds that fit this criteria, and we're going to be looking at a couple of them. So first one that we're going to be looking at is the Canadian High Dividend Yield Index ETF, VDY. This is a popular one here amongst us Canadians. So you can see the management fee here. It's higher than the US counterparts. So it is higher here. So that's something to take in consideration. And again, I'm not going to go over the tax efficiencies or the benefits of cost on this video, but just take into consideration that the management fee and the total fee here is 0.22 because that's the management fee plus the expense ratio. So again, this is a little bit higher, but in my opinion, 22 cents compared to 10 cents, sure over many years it can compound, but it's not really something to get wrapped up into. I feel like a lot of people, get wrapped up into this expense ratio. Oh my God, it's, 0.1 higher or 0.2 higher. It's not that big of a deal. If it's a percentage point or two, then I totally understand. But if you're getting started investing, a lot of these, if they're under 0.4 or 0.3, that's pretty reasonable in my opinion. So again, nothing significant in my opinion, but you might, have a difference of opinion. So that's something for you to look at. Here, the yield here, it's a lot higher. So this is a high yield, high dividend yield index ETF, VDY. So it's focusing on a lot more mature dividend paying companies. So you're getting almost 5%. So it's 4.84% as a dividend. So that is a great dividend yield. Here we can see, AUM's at about 2 billion. So it's assets under management in the total fund. So the overview, this VDY seeks to track to the extent possible before fees and expenses the performance of a broad Canadian equity index that measures the investment return of common stocks of Canadian companies that are characterized by high dividend yield. So these are Canadian companies. So if you're looking at getting Canadian exposure in Canada, you don't want to invest in US companies as much because of, currency risk, currency fluctuations, or you want to do it in terms of tax purposes. You want to save on withholding tax because when you get a dividend from the US, you have to pay a 15% withholding tax unless that equity or stock is held in a RRSP. Then this might be a great option for you. So that's something to consider here. And then you're getting that dividend income in Canadian dollars. So the fund highlights, it's passively managed. it's efficient, cost effective, and then we're going to go down and look at the total returns. So here you can look at the total returns like annually, monthly, cumulatively. So you can go and look at this, over the 10 years. It's given you what 120% over the 10 years. So you can calculate that as well, and since inception. So that's something you can definitely look at if you wanted to, and look at that on your own time. And then down here they have it very accurately, summarized again. If you just wanted to look at it over the 10 years, it's got about 8.25%. So that's super respectable in my opinion, 8.25%, and since inception at 8.64%. So this has performed very well over 10 years, and you can see its performance here, year to date, 1 year, 16 years. So it's done very, very well in my opinion. And if you wanted to look at the other performances or whatever, you could just export this table, and they kind of do it into Excel. So here, if we looked at, this is a graph showing the investment value of if you invested $10,000, in 2012, how much it would be worth now. So that $10,000 would have grown to about almost $24,000, 10 years, or however long that is. Yeah, about 10 years later. So if that's great to look at as well. You can fool around with that. Scroll down, we're going to look at the portfolio. So this portfolio is made up of 56 stocks. So it's a lot lower number of stocks in this ETF than we looked at the US counterparts. So that's something to consider. You're a little bit more concentrated here in those specific names, so not as much diversification. So the price to earnings ratio here, so that is a lot lower here, 12. So super reasonable price that you're paying for those earnings of those companies. It's not in the high 20s like we looked at in the S&P 500 ETF VOO, or even in the 18s or 19s at VIG. So it's a lot lower here at 12. And the return on equity is also lower at 13%. And the earnings growth rate is also lower at 9%. So even though these are lower, these are still respectable earnings growths and return on equity, and they are kind of consistent. So that tells me that they are large, blue chip, established companies that have a history of growing dividends over time included in this ETF. So you can look at the market cap here. It's basically saying it invests, 90% of it into large cap companies that we kind of expected as well. So if you scroll down, it's 100% in companies in North America. That's what this ETF has invested in. Now here are the sector weightings. So in Canada, like if you watch my other videos, our economy is basically made up of financials, energy, and telecommunications and utilities. That's basically it. So the first of the categories, financials, we have our big banks here. So you have like RBC, TD, Bank of Nova Scotia, CIBC, National Bank. You have BMO. So those are the big 6 Canadian banks. So that makes up the large portion of this fund. And Canadian banks have a high dividend yield, so they pay out a lot of dividends, and they still have respectable growth rates. So they do grow earnings over time. And what's weird is a lot of people have asked me, or I've heard, oh, why do you invest in banks or Canadian banks? They're not like crazy growth companies. That's true. They don't grow as high as technology companies. They're not growing 20-30%. But the power of compounding here with some of these great, banks, they're so integral, they're so plugged into our economy and such an essential part that they don't need to return 20%, Over 20-year periods, these banks like TD and RBC have returned, 13-14% per year over a 20-year period. That is great and consistent growth that you can rely on over time. So you give me that rate of return that's higher than the market rate of return over any time period. I am comfortable with holding that and holding those banks in my portfolio. So that is, something to consider, and I've thought about that a lot. But I feel like it's just kind of a common theme where a lot of people don't invest in banks because of that reason. But the Canadian banks here, I do understand on the US side. The US side is a lot more fragmented. There's not as many banks, but the big 6 banks have a pretty strong hold here on the Canadian economy. And they have great dividends that they pay out and dividend growth. So I'm comfortable investing. And for full disclosure, one of my work ETFs is mostly invested into the financials here in Canada because of that reason. Then we have energy here at 28%. So energy is at 28%. We have telecommunications at 8%. Utilities here at 6%, consumer discretionary, base materials, industrials, and very little real estate. So just scroll down. So, like we saw, the banks make up the large portion here. RBC being the largest at 13%, TD following up at about 11%. You have Enbridge here, pipelines, 7.73%. Canadian National Resources at 6%. Bank of Nova Scotia, Bank of Montreal here at about 6% each. You have BCE here at 4%, TC Energy, Suncor, and CIBC. So again, financials and energy, they're kind of the top holdings here, and then some telecommunications here as well. So that's VDY at a glance. You can see all the holdings if you wanted to. And then you can also look at, if you want to, just click the fact sheet here. And this fact sheet's like a 2-page summary. Well, we might as well click it since I said that. It's kind of a 2-page summary explaining what's held in this ETF provided by Vanguard. And it's, it's very concise, to the point, and kind of just, gets the job done. Looks at what we did at a very high level. Okay, sorry, just loading there. So yeah, VDY, you can see basically everything I talked about here. The performance since inception, the number of stocks all here included, and the top 10 holdings here. So the top 10 holdings make up almost 70%, so you're pretty concentrated in these names. But again, you can just, basically everything I said, just included in this 2-page PDF. So that is, super great to look at and very concise. So if we look at that, now we're going to go back and look and compare this fund. So see, as you can see on the Canadian side, they do have a comparison tool again if I'm comparing this. And what I'm going to look at is VFV, and that is the S&P 500 ETF on the Canadian side. So instead of VOO, you're looking at VFV, and we get that same different warning that, hey, your funds that you're looking at or ETFs are in different investing categories. So please be aware of that. They're in different investing categories, Canadian dividend and income compared to US equity. So again, you can do this comparison. You can see the management fees here, compare those, the assets, the inception dates, the yields, the dividend yields, and then you can see the average annual income, the asset allocations. So this is actually pretty cool. I didn't know that they did this. This is actually a lot cooler, and they should actually include this one on the US side as well, but it's just stock or bonds, so it's essentially the same thing. Here we can look at the equity characteristics, price to earnings. So again, you're paying a higher multiple here. You can look at the return on equity. So top 10 holdings. Here they have for VDY, and here you would have to actually go to the S&P 500 index to look at the holdings. They should include them here, but I'm not sure why they don't. So again, and then this sector breakdown. So this is really cool actually. So you can see the different sectors that you would get exposure to, comparing VDY compared to the S&P 500 on the Canadian side. So you can see a lot higher exposure on VDY in the financials, 5 times that as the S&P 500. And then again, you can look at technology, basically nothing here on VDY and 26% here on VFV or VOO on the US counterpart. So this is a super great infographic as well when comparing your funds. So yeah, you can totally look at that and see I encourage you to go to the Vanguard site, type in different tickers and explore their ETFs if you're interested in ETF investing, and use this comparison tool because it saves you a lot of time and you can look at them very quickly and see which ones might actually fit best with your investing goals and your different time horizons. So that was essentially my video on ETFs and how to invest into them, and how to look at the differences between mutual funds and ETFs, and describing what an index fund was. Now, if you wanted to actually go and invest into one of these these ETFs, you could go to your brokerage. So for instance, the one that I share on my channel is Wealthsimple, and I like Wealthsimple because if you wanted to invest in an ETF, you could go buy one, and if you're buying it on the Canadian side, you do not pay any commission fees. You can buy it, if I was to buy VDY like we looked at, I would be able to buy VDY, not pay a fee, and add that ETF to my portfolio. So the only cost there I would pay would be to Vanguard for the expense ratio. which is super, super small, like we saw. And you could also look at different brokers such as Questrade, TD, all the banks have their own brokerages. So see which one would be best for you, but all you would have to do is go to your brokerage, type in that ticker symbol you're looking for. So the ones we looked at, if you're on the Canadian side, you'd be looking at VDY, or the S&P 500 if you wanted that one, VFV. If you're on the US side, you could use your US brokers and search for VIG or VYM for the dividend ones, and VOO for the S&P 500 one. So that was my video for today. I hope you enjoyed it, and I hope you have a great day. If you enjoyed it, please like and subscribe to the channel so I can keep producing this content. And thank you again. Bye. Again, I am not an investment advisor by any means. I make this content only for your entertainment purposes only. So please do your own due diligence when investing. Investing is risky, and I'm not liable for any investing losses you may incur. Thank you.